Okay, so you should see my iPad. Let me put the chat. People seem to like to chat today. I'm presenting Isaac, do you see?
Yeah, now I do.
So let's recap. You see this? Do you see? Okay, so NPV, you compute the NPV of a projection of cash flows to evaluate the feasibility of a project. The NPV gives you a dollar amount. Okay, and essentially the NPV will always give us the right answer. However, when we're analyzing independent projects, so we're just evaluating projects on their own merit, NPV will give us the right answer. If we're comparing projects, we pick the one with the highest NPV. But what's the problem with NPV? Why do we even look for other methods? What's the problem with NPV? No idea. The disadvantage of NPV is that we need the discount rate. You need a discount rate in advance, and some people will feel that they're not confident about the discount rate they use. They have to think, well, if I don't invest in this project, what will be return on my dollar investment? Or what should I expect? Or what should I desire? And they might feel, even though in this class, I'm giving you the discount rate, in reality, what should it be? So that might be a drawback. So we have other approaches that we include that doesn't well, I guess the thing that the measure that doesn't require the discount rate is the payback period. The payback period gives you the number of years or duration or time to recover the investment. Okay, so it's a different kind of measure. You probably use it in tandem or together with the NPV to make a decision. In calculating the payback period the payback period, you may feel that maybe it's better to do the discounted payback period instead, because at least I care for a time value of money there. And more more remote cash flows, like cash flows that are further off in my projection, are not as significant as cash flows coming up front. So I'm going to employ a discount rate to evaluate those. And then we talked about the internal rate of return a lot, and I left you with a number of exercises to try and interpret how to decide on investment with cash flows. We talked about investment projects, finance projects, and we talked about mutually exclusive projects where you have to pick one. So that's what we did. IR gives you a percentage, and depending, it's either you interpret it as a return on investment, or you interpret it as a borrowing rate. In the first case, if it's an investment project, with the first cash flow as a negative and the rest are subsequent positive with only one sign change. Or it's a finance project where you collect or you obtain funds financing up front, and then you realize the project by dispersing the funds to deliver service or product. And lastly, we have the profitability index, and the profitability index is a ratio. It's a cost benefit ratio, or a we're going to look at the benefit over the cost in this case. All right, so that's what we're going to do. And the way we're going to do that, the benefit is the present value of future cash flows, and the cost is the initial outlay. And here is our discount rate. Here we call it a hurdle rate. It's another term for our discount rates, the percentage we have to over or supersede with our investment. So let's calculate the NPV and the profitability index. Sorry. I have to. So to calculate the NPV, you can use your finance calculator. Remember how you get the NPV. Use your finance keys. So I'm going to go into my CFPs. I see something there, so I hit second clear work. Try and avoid using the reset button, because then you have to reset all your settings. So just use that clear work in this case. Once you're in the sheet, you can clear it. And let's put in negative 1100, enter down. Now the first cash flow is 500, and there's only one of those. Enter down, down, and then 1000, and there's only one of those. Enter down, down, and ask for the NPV. And second NPV asks for the interest rate, which we've been told is 10% for this project, and compute NPV. So I get the 180.99 on the exercise in the notes. Got it? To practice that. Let me know if you have any problems. Okay, no comments. Okay, so now we found the NPV, but let's get the profitability index. Now we could calculate the present value of future cash flows back to our calculator. Let's calculate the present value of future cash flows by just forgetting about the initial investment. Let's put a 0 in there. All right, and then leave 500 and 1000. If we do that with the same 10% and compute NPV, now we get 1280.99, which gives us this, right? So that's a way to do it. Or you take your NPV and you add back the initial investment. That's what that stands for. So let's just make a note if this is confusing. C0 is the positive version of the first cash flow. Okay, so CO is the positive version of the first cash flow. Careful with that notation. So that's why it's a positive, and all I want to do is offset benefits and costs. I don't need a plus and minus because I'm comparing these in a different way as a ratio. And I get 1.2. What does it mean? It means that I've got, bang for my buck. I've got 20% more for the dollar invested. So that's good. Questions? So I should invest in this project. Okay. Now, keeping in mind, there are actually 3 types of project analysis that I mentioned at the beginning of this unit. There's independent project analysis where you use a rule to check if a project is feasible. They're mutually exclusive project analysis where you only can pick one. You can't afford all projects, but you can afford at least one. And you want to pursue the best one. And capital rationing is different because here capital can be rationed. Well, it'll be rationed, meaning you can't necessarily afford all projects, but you can allocate financing to more than one possibly. So here's an example. My example is that I have this information here with the initial investment for project 1 being $20 million. These are in millions of dollars. And 2 and 3 also being $20 million, but they're 2 projects. So the question is, should I pursue project 1 or project 2 and 3? And what's the answer? I feel like we discussed this already. But anyway, for the people who weren't here, didn't see, this is how you wrap this up. So which one should you pursue? How do you conclude with the information you've been given? Comments? Is it my volume? You reading? No comments? Should I continue? I need some feedback. I need some feedback.
You should choose project 2 and 3. They're much better. Basing it on the
No
PI,
feedback.
also the NPV. Oh my God.
All right, we'll just continue then. So you compare project 1 with the others, but
Okay,
you
can
add
you
these
hear
together.
us?
right? The NPV will be the total net present value. So taking 2 and 3 as an NPV of $50.40. Not $50.40. Why do I have that? That's not $50.40. That's the wrong number. That's nice and confusing. How much are those together? Maybe that's why you're quiet. You compare those that they're greater than $50.40, but let me erase this. That's confusing. So 35 and 28 and 33.37 are obviously greater than 50.47. So these make and so we should take the higher NPV project, which is the combination of these two. So we should pick 2 and 3. Another neat thing to see now is the advantage. So I introduced the profitability index with no clear advantage to introducing a new technique, but here we do see it. It's popular, or its popularity depends on people knowing this, that if you have to conduct capital rationing, so you ration, you don't have enough, right? When you ration water, it's the same. You don't have enough and you have to spread it out, and you may go without. In some cases, in this case, you won't be able to afford project one. If you look at the profitability index that's been calculated as the present value of future cash flows divided by 20 million or 10 million, it shows you, if you rank these, and you put them in order, this one is 1, this one is 2. Well, maybe I shouldn't use, well, I guess I will. So in terms of ranking, project 2 is the best, project 3 is next, and then project 1. So it shows that these are the top of the pack. Another reason to choose 2 and 3.
Professor, can you hear us?
Okay, so I explained that here. And it's just showing you how much you get per dollar in dollar return. Okay, I figured you guys, I can't hear you. So let's see what's going on. Oh, I have these back. That's my microphone. And now it was too weird that you guys weren't speaking. All right, now you can speak. Go ahead.
Hello.
So, yes, tell me. Okay, it works. But you're happy with what I described as now? Makes sense.
Until now, I understand.
Very good. Very good. Okay, so all right, so you have several exercises. We looked at many, and I'm just reviewing the notes because I did post video descriptions of the notes. And in an overview, so I reviewed the different techniques here. And what motivates having one versus the other. So in practice, what do firms use? Okay, so there was a study done of an interview with CFOs and their teams, And it looks like the IRR was most popular. So 75.6% indicated they use the internal rate of return. So that's the most popular. And it's for the reason that I explained that you don't need a discount rate to calculate it. And in fact, it gives you a range of possible discount rates that would make the project feasible. So it's very practical that way. And a close second is the NPV, and probably because the IRR depends on the NPV. In the end, you are just picking regions or ranges of the discount rate where the NPV is positive. So you're going to be using these two, but IRR is the leader. Very close second, though, is NPV. And far third is the payback period rule and not the discounted payback period rule, because this is just a kind of back of the envelope calculation. You just can calculate this on a napkin or in your mind, adding projected cash flows together and thinking, oh, well, I get my money back, or we'll recover our costs. You can communicate that information within a few years. And if you want to be more precise to get a value so you can compare alternative investments, then you use a discounted payback period rule to be more precise with the taking account of the time value of money, remembering that these two shouldn't be used in isolation because they ignore future windfalls, like, relatively high future cash flows and possibly detrimental future cash flows. So you want to use them together with a measure like the IRR or the NPV. And lastly is the profitability index, although it is used according to the study, and this is kind of old now. I have to check if someone's renewed the study. It looks like it's not popular relative to the others, but it is used, and this just may have to do with the only bonus is the capital rationing question, and it helps you rank alternative projects and see them immediately for how they compare, which ones are better. So maybe that information is unknown to its users, or people are just satisfied with the other metrics for evaluation. And that's all I have to say. So as I mentioned, you have the exercises online, and let's look back at the one we were discussing on Friday. We left off here. And let's try, I'll leave you with this for a minute. Question 5 and 6. Oh, and then we're going to get into unit 4. Okay. So really, I'm glad you showed up, because this is just an overview, and I think unit 3 doesn't need to take too much time. Most of your time studying will be in unit 4. So looking at 5. Oh, I guess I have to show you the cash flows. All right, so let's do that. Let's do 5 first so we can see the cash flows. It's better. Ignoring the information in question A, this should say question, the question above. No comments? Am I gonna solve this? No comments? So it says don't use the information. In the question above, it's referring to the information on the internal rate of return. Assume instead A and C, so you're not going to care about A and B right now, you're going to care about A and C. And you're going to calculate the IRR. You're going to make sure this is correct about the IRR of A, the IRR of B, and then you're going to verify the profitability index of A and the conclusion and the profitability index of, okay, then question D, that has a different conclusion. So let's go through each one. Let's look at project A and make sure the IRR is 14 and that for C is 41. Now, if we look at project A is an investment type project because the first cash flow is a negative, the rest are positive, and so is project C. So let's calculate the project A. Make sure there's nothing, we have to clear it. And now 400 negative, enter down, oops, down. And then 100, enter, down. There's only one of them, 110, enter with a frequency of 1. 120, enter with a frequency of 1. 130, enter with a frequency of 1. And 140, enter with a frequency of 1. And compute NPV with a discount rate of 10%. Okay, number 5. And then compute NPV. So the NPV is 47.69 or 70, but I really want the IRR, which is 14.3 or 29. So that's right, 14.29 or 0.3. What about C? Why are we here? While we're here, let's get the PI of A. Let's find the PI of A. And the way that we do that is, let's put a 0 in for let's say this is correct so far. Let's do now the PI of A. Let's put a 0 in for the cash flows, the first initial one, and then recompute the NPV. So the NPV is 44769, which we can store. And then we want to divide that by the initial investment, which was 40. Oh, let me do my split screen again, so we can see those together. So I'm going to divide by 400. And that's how you get 1.19, 119 or 1.12, which is correct. So this is correct as the PV, sorry, as the PI of A. And then let's look at C. So let's put C in. So let's clear the cash flow keys and put in C. So C is 200 negative, enter down. And that's the initial cash flow, and then 400, 100, enter down, because there's one of them. Oh, they're all 100. So actually, let's go back and put frequency of 1, 2, 3, 4, 5, right? 5, enter down, and we're done. So we can calculate NPV with 10% and recompute NPV. So that's NPV. What I want is IRR right now. What happened? That's interesting. Let's look at that again. So CF was, oh, is that why? Because I put 200 negative. You guys didn't catch me. All right, let's do it again. Negative 200, then 105 times. Okay, let's do that again. So I'm going to get the IRR is 41%. So this is correct for C. And let's get the PI now. So let's get the NPV compute after scrolling down. So you have 17907 dividing by 2. The positive of the initial cash flow is 0.89. It's not right. Okay, let's do that again. What did I do wrong? Oh, because I have to fix it first, right? I have to go in and override 0, override the initial cash flow. So that is the NPV, or that's the present value of future cash flows. That's it, right? They have to add back the 200 and then divide by the initial cash flow and as a positive, and then you get 1.89. So that's correct. Okay, so we have all the numbers. 1.9 is the rounded amount. So all those are correct. So what's the decision? You have all the values. What is the decision? No comments? Are you guys there?
I would choose C or B.
Okay, so let's go through them. So let's look at B. IR project A is 14%, C is 41%. And they are both investment type projects, but so the problem is you can only pick one, or what do they say here? And they're independent. So you don't have to make a mutually exclusive project analysis of incremental cash flows. You just say, I'm going to pick A, I'm going to pick C. Oh, but the way I wrote it, A is better than C. We're not supposed to say that when it's an independent project analysis, right? But we do capital rationing. When we use capital rationing, we're supposed to go immediately to the profitability index. So yes, these were calculated correctly. We shouldn't be comparing them if they're independent. Independent just means, is this greater than the discount rate? Yes. Is this greater than the discount rate? Yes. And you should actually pick, in this case, because they're independent, you may not be able to afford both. An independent analysis says this one's good, that one's good, but with capital rationing, what do? You have to rank them in terms of the profitability index. Okay, so that's the information you got from our previous discussion. You have to use profitability index. So you don't look here. You actually get the profitability index of each, and that's what I did here. And in profitability index, the C is better than the A. So in fact, some people have a problem with this answer because they say, well, it should be also B, showing C is better than A, because project C is 41% and that's better than A. But that's just a coincidence. That's not necessarily the case in general, that the IRRs being in the right rank order as the profitability index, it will be the case. All right, so you should look at the profitability index if you have capital rationing. And I'm not saying you can't afford both, or you can only afford one, but if you had to choose which one is the best, C is the best. And this is because of this word here, that they're independent. I'm not doing a mutually exclusive project analysis. Now, if you did do one and you took, you would take C over A, that'll look weird. That would be a finance project. But anyway, let's avoid that. Let's avoid doing the wrong thing. Okay, so the point is, independent project analysis, you have to have a metric to compare them, and the best one, the one that works and gives you the right answer, is the PI. All right, we have another question here, one left, unless you have questions for me. Let me look at that. Okay, how'd it go? Which of the following statements are true? I don't need the cash flow, so let's see. The NPV of project, oh, I do need the cash flow. The NPV of project D will be much more sensitive to changes in the discount rate than the NPV of project A. All right. So D starts with -400, and the highest of the future cash flows is up front. So that means that the discount rate is not going to, the higher the discount rate, like these are pretty level, like they're similar. So a high discount rate will turn this, or the higher the discount rate, it will make this meaningless or very small out in year 5 or year 4, right? So in this case, the big cash flow is not out there. So that's not such a strong statement here. But comparing it to project A, now we have a relative measure. They have the same initial outlay. And you see it's the reverse. So when I see these two, which one is more sensitive, or which one which one is more affected by the discount rate? So a higher discount rate here will really diminish the 140, making it less able to offset and make this project profitable. So this set of cash flows prefers a low discount rate, and this prefers relatively higher discount rate. So I don't know if sensitive is the right word, but I think they both are sensitive to discount rate. So let's skip A. B, if projects C and D are mutually exclusive, incremental analysis indicates that one would reject C and accept D. So let's see C and D. So we need to make a calculation for C and D. How should we make the calculation? How should we perform the incremental project analysis? Which one should I subtract from which? Any thoughts? So my suggestion was that you want to,
I think C's
you're
C's would be rejected and D's should be accepted
okay.
because of the cash flows.
Okay, but the issue is that D and C, and when I compare D and C, notice that D has kind of the timing problem relative to C, because you have the highest cash flow at year 1. Let me show you with my pen. So this is, first of all, okay, well, this is the highest and then it diminishes, and these are all the same. So they're acting differently. They have like a different downslope that you would see. And then in terms of the initial outlay, this looks like a higher budget project is actually double the investment of the first one. So those two problems, the size and the timing, might create an issue with overlapping NPV profiles. Without drawing them, what I do is calculate the incremental project and I analyze that instead. So what I do is I first I have to decide which way am I going to subtract them? If I don't know which one's necessarily better, I'm going to subtract them so that the first one is a negative, and that will happen if I take D minus C. If I take D minus C, then I'm going to have minus 200, you see, because if I take minus 400 minus 200, it's actually minus 400 plus 200, which is minus 200. Let me write that a little better. Continuing with D minus C, this will be 40. You see how nice this is? And so now I look at this what's called the incremental project, which means pick D over C. Or D instead of C. But I analyze this as an investment project. So let's check if these cash flows have an NPV that's positive. So going to my CF keys, let's clear because there's something there. And putting in 200 negative. And then 40. There's one of those, 30, one of those, 20, one of those, and 10. And then you compute I have a discount rate of, I don't have a discount rate. So let's use the IRR. That's the whole point. And well, what does that mean? Let's make sure I did this right. So negative 200, 40, 30, 20, and 10. So then IRR compute. So what does negative 27.35 or 36 mean? What would that mean if I did it like this? So if I did it like this, IRR is equal to negative 27%, 27.4. That's confusing. Do it the other way, but then you still have to analyze what's a finance project. So will this project ever be accepted? Will IRR ever exceed the discount rate? I don't give you the discount rate there in number 6. Okay, so what you would say is you accept D instead of C. But this will never happen, right? You'll never have a discount rate. You'll never use a required rate of return that's a negative. So this is not possible. So it basically means you pick C. So are you with me? Am I lost you? So this suffers from a problem of timing and scale, as D is a double budget project, 2 times higher. And timing, these are reverse, or this, the first cash flow is relatively higher than the last. So that means you prefer lower discount rates, higher discount rates than a project with the reverse set of cash flows. So my conclusion would be that I should instead pick C instead of D. If you did just the IRRs, well, you shouldn't, right? You should always do the incremental analysis because you're not sure if these are going to be overlapping. NPV profiles. All right, so let's see what they say here. The NPV of project D will be much more sensitive to change in the discount rate. So we read that. Not necessarily, because they'll both be sensitive. If project C and D are mutually exclusive, incremental analysis indicates that one should reject C and accept D. In fact, we found out that that's not true. And then it is possible for project A and D to have the same NPV. It is possible for A and D to have the same NPV. Okay, so this is a different question. So looking at A and D now, is it possible for A and D to have the same NPV? In other words, do they cross? That's what it's asking. Okay, so in other words, well, let's look at A and D. They have the same initial investment, so that's fixed. But then these are the reverse cash flows, and that's exactly where we see overlapping, or not overlapping, but crisscrossing NPV profiles, because the A prefers a lower discount rate, D prefers a higher, or relatively doesn't care, and a higher discount rate is fine for D. So they will overlap, and it is possible, or they will intersect. Just like, let's see, back to the notes, just like here. Okay, so they won't be nice and non-intersecting profiles. All right. Okay, so I feel like I am done with this review. Any questions? So yes, that was challenging. Oh, sorry. 1 second. So yes, that was challenging. I agree. It's good practice to be challenged. The best answer is so if you had this on a test, you can see where you would go wrong. So many places. That's why I give it for practice. Okay, so it's 10, almost 10:30. Let's move into Unit 4 unless you have any questions for me. Okay, no topic, no comments. All right. Let's look at projection of cash flows. Stop sharing for a moment. So I'm going into Unit 4 now. And I'm going to ask you to look at the UR case. So that's where we're going to begin. We're going to begin with the UR case. Okay, so it's this unit. In this unit, we're going to do capital budgeting. Okay, so I'm going to give you information and you are going to determine the projection of cash flows. right? So first of all, we start, I give you the cash flows and I tell you which technique to use. Beyond that, I give you cash flows projections for a project, and then you have to determine which is the right kind of analysis, which technique is the best one to use. And then deeper, now I'm going to give you a bunch of background information that I select, and using that information, you're going to determine the project cash flows or projection of cash flows. And then the next unit, unit 5, you are going to be able to do all of that, plus you're going to determine the discount rate, the appropriate risk-adjusted discount rate. So we are learning with great depth everything about capital budgeting, right? So for now, we're going to start with this case. We're going to read it together. And what we're going to highlight are the incremental cash flows for the project.
Sir, if you're presenting, we cannot see it.
Yeah, I didn't put it up yet. I was just,
Okay.
thank you. Thank you for telling me. Yeah, I'm going to share. I was just cleaning things up. Oh, there. Okay, so let's read this together. Let me double check that you have the revised version, because I just made a few minor edits. So if you can, print it up or put it on your tablet so you can mark it up. Okay. So let's read. UAir is a hypothetical leading American airline which transports passengers, cargo, and mail to 63 cities in North America. UAir provides jet services to cities located in the US, Canada, Mexico, Europe, the Middle East, and the Caribbean. Revenues last year totaled $5 billion. The airline is considering opening a new line to the Bahamas. Okay, so this is the project. Now, as we read through, identify which cash flows are important or incremental to the project. An incremental cash flow is a cash flow that occurs because you've chosen to pursue the project. Last year, UAir hired a consultant to develop and test a marketing campaign at a cost of $2 million. Given the competition in the airline industry, the consultant recommended to maintain the New Bahamas line only for 4 years. All right, $2 million. Is that an incremental cash flow? No comments? Yeah, I'll leave that for you to think about. I can't just give you it all, right? Given the competition in the airline industry, the consultant recommended to maintain the New Bahamas line for only 4 years. So this is a number that I'm going to enter, underline to remember. This is a 4-year long project. So it's going to have future cash flows that we have to compute. Her predictions indicate that UR can sell 16,000, 24,000, 30,000, 22,000 round trip tickets to the Bahamas during the first, second, third, and fourth years of the project. Okay, so are these incremental cash flows? Well, these are not cash flows, right? These are just units of sales. So to make them cash flows, we need the revenue per ticket. So the consultant recommends that you are charged 2,000. Now this is the charge, but there's also a cost that we're going to look at. This is a revenue, and we're going to look at the expense of flying customers. So together, are these numbers incremental cash flows? I will just circle 4 years because it's not exactly, it's not a cash flow. Comments, no comments. All right. So I'm gonna keep going because I need you guys to speak up. Round trip ticket to the Bahamas. She forecasts that if UR chooses to launch the New Bahamas line, it will compete with its flights to other destinations in the Caribbean. As a result, UR will lose sales. These are the sales. Lost sales. Are these incremental cash flows? And the cost to those other destinations is also estimated revenue. Sorry, not cost, but revenue is $2,000 a flight, approximately. Well, what we'll call these are incremental. These will make incremental cash flows. In fact, this will be incremental revenues. And these lost sales will be like a cost, an economic cost of producing or pursuing this project. We're going to refer to it as a side effect of the project. Now, side effects can be positive, and we'll talk about that in a bit, or they can be negative. Now, this is a negative side effect. That you're going to lose sales to other destinations. Continue reading. UR CFO and his aides estimate that the company's average variable operating cost per round trip ticket to any Caribbean destination, including the Bahamas, is $1,000. So remember, I mentioned that we have the revenues, we also have the cost. So the net revenue would then be $1,000 a flight. They note that since the airline has a vacant terminal, there is no need to rent an additional terminal for the proposed Bahamas line. The annual rental cost of a similar terminal is $10 million, and the CFO's team claims that having the vacant terminal will save the airline these costs every year. And what do you think about that? Is this an incremental amount, the $10 million? You guys don't really need me to repeat this information unless you're engaged. This is pretty much in the videos. I want engagement. So unfortunately, engagement just seems to mean one person responds, but let's make the most of this time together and think this over and let me know your thoughts. Is this an incremental cash flow? Remembering incremental means occurs as a result of taking on the project. And understanding the definition of a cash flow, out of pocket or in pocket, into pocket, actual dollars that pass through accounts at least, or digits in a ledger. Comments? Well, the $10 million is it's not spent. It's not like, okay, so basically we'd have to buy a terminal to house the planes, right? If this was our company, we'd have to have a home base for the planes. So usually airlines rent terminals at airports, or they could own them. They can own them too. In this case, Bahamas happens to have a home base terminal already, even though they're not using it. The market value of the terminal is $10 million. Now, despite the fact that they're not renting it out, that's irrelevant. It has a market value, $10 million. From the perspective of the firm, this is an economic cost. So this is an incremental cash flow. It's an economic cost, and we call it an opportunity cost. We use this word a lot for different things. In this case, it's lost value, right? Because we're not going to be able to rent this out. This has to be worked into our calculation that this is affecting. It's kind of like a side effect because it affects the firm at large, or the other operations of the firm and how it impacts those. In other words, affecting the firm at large. So this is it. We're taking this out of the possible revenues for the firm. So this is an opportunity cost. So this is incremental. All right, what next? The airline vice president and customer service and operations determined that for the predicted ticket sales, the airline must purchase 4 planes. U.S. Purchasing Department has decided that the most suitable airplane for this line is DC-9. The cost of a new DC-9 is $10 million. Is this $10 million for each plane. Is that incremental? Oh, I didn't put down that. Let me write this as an incremental expense here. That's for the cost of the flights. How many of you actually watch these videos? Because maybe I'm just being repetitive, and are you bored? Because I already covered this in the videos. Um, so $10 million.
The planes will be an expense, right? It will be $40 million taken out from the revenue.
Okay, so very, very good. Thank you for the suggestion. The catch here is that for tax purposes, this is a capital expenditure. This is not a regular operating expenditure. Okay, so this gets a different tax treatment. In fact, we're buying an asset, planes, that have a depreciation. So we're going to take advantage because the IRS allows us to depreciate. This is America in this example. So it allows us to depreciate the planes over time. And even though we don't know if they really depreciated, like they experience wear and tear and breakdown, they have to be, maintained in the interim, but really that we get to, as a firm, we actually get to expense that. We actually get tax savings because of a loss, right? So that is the difference here. So this is an incremental cash flow, yes. It's an incremental cash flow in particular. We call it capital spending. This is your investment. This will be our initial investment in an asset. So similarly, you buy an equipment, you buy a building. And in terms of taxation, you will be able to expense that and claim the wear and tear and realize tax savings. And that is the cash flow impact, are the tax savings. Depreciation is not a cash flow. Okay, it doesn't change hands, but what does are the tax savings that result. And we'll talk about that in more detail. So in terms of depreciation, we are going to use the 7-year depreciation rate, or the period for discounting, or sorry, for depreciating and claiming a loss for the firm. So we're going to use what's called the maker's table. Are you familiar with the maker's tables?
I'm not.
So I've put this into the, I put this onto the platform. This is just an example. You can get this information through the IRS, and it's very nice. It helps you calculate depreciation each year, the big D you'll see in my notes. So each year you get to depreciate. In this case, for the 7 years here, in the 7 years, in the first year, it's 14.3% depreciation on the planes that are allowed. Now, each category applies to a different class of assets. So buildings depreciate slower, so they could be under 10-year or 15 or 20-year depreciation, and equipment, electronics depreciate sooner, right? So 5 years or 7 year. So what you see here is these numbers, and you use these numbers. I'll show you how to do this. Now, this is actually in the first year, this is half of 28%. It's half of 28.6%. And what is the reason for the half? Does anybody know? We can talk about that later too. I'm going to leave it for now. So think about that. Why is it half in the first year? You might know from accounting. And then after that, it's double declining balance depreciation rate, which results in those numbers that are in the schedule until they switch to straight line depreciation in the 5th year, which you can see here. So in year 5, it just divides by, 5, 6, and 7. It divides evenly into 8.9 or 9% depreciation, and then you have the residual in the 8th year left over. So I got to teach you how to use that information. So you need to use this to find depreciation in each year and calculate the cash flow savings, and that will be incremental. So tax savings, which I will call a tax shield, or tax shields in each year, are incremental. So I just give you this amount of information, right? With this, you go ahead, but you can imagine to do this yourself, starting from zero, from scratch, gathering information that's relevant, pertinent to the project. You can see your decision and your assumptions about what to include will change your results, right? So it's customary to do a series of projections, right, with different information and looking at the sensitivity of your results to, including and excluding some components of the information. And you'll see that as you do the exercises. So have any of you done capital budgeting like this before? Something like that, like this? If not, you're going to enjoy it. It's enjoyable. It's a lot of information at first, and you have to do a bunch of reading, it looks like. But if you just go step by step, don't be overwhelmed, read sentence by sentence, just like I did, you'll be fine. Let's see what else we have. So, okay, so a DC9 lasts for 30 years. So even though depreciation's in 7 and the project is only 4, I keep that in mind too. It's only a 4-year project. The planes will be scrapped after 30 years. So if we actually get to the 4th year with our project, we determine, or we estimate that we can sell the planes for a total of, well, not total, for each from $10 million to $3 million. Now, we have an asset and we're selling an asset. As a result, there may be capital gains if we sell it for more than the book value, or capital losses. I'll just say losses. These will be incremental cash flows as well. So you have to figure those out. It means that you have to determine the book value, what's left of the plane after depreciation, and whether you're selling it for a gain or a loss. And remember, you have to pay taxes on that, right? So you have to consider the after-tax value of that. All right, lots of information. So finally, the last piece with regards to the daily operations of the Bahamas line, we have here net working capital, current assets and current liabilities. Now, here's just a bunch of information. That we're going to use to compute the net working capital investment cash flows. Asset inventory. So up front, we have to have an inventory of worth $600,000. We have to have $1 million in cash, $1.3 million in accounts receivable. So we're going to add these and subtract these. And we're going to get net working capital requirements. So we're going to talk about that and calculating the net working capital investment cash flows. Okay, and we're going to answer the question, calculate the NPV of the proposed Bahamas line. Assume that the nominal required rate of return for the project is 10%. So I give you this number up front. You're going to treat the cash flows as nominal and determine if you should carry out or pursue the Bahamas line. So obviously the decision is dependent on all these assumptions you've made. And if you're not comfortable with the assumptions, you can make another set of assumptions or modify these to see if you still would accept or reject the project. So what we're going to do is, sorry, I got kicked out for a second here. And I lost my cursor. About sensitivity. I don't know what's happening. Going to get out of here for a minute. I don't know what you guys saw, but kind of booted me up. All right, try that again. I don't know. What is- Not sure what's happening. Okay. Oh, this thing's not. My holder is rebooting. Let's try something else. Just having trouble with the projection. Okay. One more time. I think I probably have to go out of Zoom and back in. Everything's breaking down. Okay, let me get out of here. I'll come back. I'll be back.